Welcome back for commodities market update. Now we see U.S. WTI futures was up by 98 cents this morning at $92.46 a barrel. We see the global benchmark Brent crude that's up 46 cents. We see it's trading at $94.89 a barrel. Dumebi Oluwole joins me now, senior analyst, financial derivatives company, joins me right here in the studio. Dumebi, I remember the last time we spoke. I believe oil was around 70s.
Yeah,
and I
think
did
76.
ask a question that is it going to get to that $60 level? But fast forward today, no, it did not happen. And it looks like the bulls are firmly in control, right now. But it's looking like more of a supply side, issue. Do you think this price rally is sustainable?
I mean, it is a supply side issue. Saudi Arabia is extending its supply cuts up until the end of the year. Russia as well is extending its supply cuts at least for the next 1 month. And all of this is just playing out in the market. So sentiments are pretty bullish, actually very bullish. Very bullish. And their forecast that oil prices could actually touch $100 per barrel before the end of the year. And with that happening, what we're going to continue to see is global central banks actually, tightening their grip on inflation, because chances are that there would be that pass-through effect from higher global oil prices to gas prices, and then, this will definitely fuel inflationary pressures globally. And if that happens globally, if we see central banks like the U.S. Fed, which will be having its meeting very shortly, and then if the U.S. Fed decides to continue tightening, we would see, African countries who are heavily dependent on importation, and they're also seeing their currencies actually take a hit because of this consistent increase in global interest rates. We'll definitely see that play out, we'll definitely see that have an impact on these countries, especially Nigeria, as of today.
Because when I check the oil market and I see prices going up, I'm afraid for what's going to happen next.
Yeah, I mean. Now that Nigeria's petrol market is deregulated, that pass-through effect will be there. But like Nigeria did, and also we even saw the same thing happen in Kenya. There's this temporary stabilization subsidy happening just to keep fuel prices stable for Nigerians, and just to mitigate the cost burden that is currently skyrocketing for a lot of Nigerians. However, like we did see in Kenya has actually taking a backseat on this stabilization, temporary stabilization, just simply because that pass-through effect has to just happen. We might see the federal government actually do this, simply because now the margin between diesel prices and oil prices is already getting very wide again. And we've also seen the naira take a hit as well. The official rate of the naira is trending lower, and this depreciation combined with higher global prices could force the NNPCL and even the federal government to allow the pass-through effect to prices. Now, what we would likely see is that it would be a gradual increase rather than just a sharp increase in petrol prices. So rather than the pump price, skyrocketing to about 700, 800 immediately, we would just see this staggered increase in petrol prices. That's what we would likely see. Still because the government is embarking or they're trying to put effort into mitigating or reducing the impact of higher fuel prices on the cost of living for Nigerians. But regardless, there will still be that pass-through effect to food prices and transportation costs as well. And
talking about $100 at this point, it's now in the cards that right now, and we've seen analysts and traders actually forecasting that that's going to happen. But I'm wondering, can the global economy take $100 barrel oil at this point?
I mean, it's not something to rule out, just simply because we're definitely seeing a rebound in global economic activities. There was a surge in consumer spending in the US by over 5%. China is also getting its feet back. India as well. So we're definitely seeing that rebound in economic activities, and I don't think it's just something to rule out. Higher global oil price is something that should be very beneficial to oil exporting countries, including in Nigeria. Although Nigeria's break-even point, according to S&P Global Part, is around $130 per barrel, and we don't see oil prices reaching that peak. However, at $100 per barrel, Nigeria should generate some significant revenue. So what this means is it's a double-edged sword for Nigeria at this point. So while we could see an increase in government revenue from oil, that would definitely feed into the federal allocation, the monthly disbursements that from FAC to state governments. We've seen that increase over time, and while we definitely see that also feed into the federation account, we could see a little bump in external reserves, and that would aid the CBN's ability to stabilize naira at the official market
to increase our output.
Exactly. So while there's that whole dynamics playing out, we also cannot rule out the impact of the reforms that have already taken place that could net this off, or offset the impact of this, just simply because there's now a direct hit on consumer wallets from global oil prices to the pumps and then to your living expenses. So yeah, it's going to be quite a tough call for the CBN, for the federal government actually, to balance out.
And the major central bankers are meeting this week. What are we expecting? Tightening, hold, or cuts just seems impossible.
No, right now cuts are pretty off the table. And that's just because global inflationary pressures are not, they're not reining in any soon. And even with all the efforts, we're still seeing this inflationary pressures increase. And the longer the Russia-Ukraine war lingers, the longer it stays, the chances of global inflationary pressures, remaining or even worsening is still very high, and that would definitely continue to feed into the considerations for all of the global central banks. And right now, it's more of like a leader and a follower kind of thing. Once the US Fed, makes a particular move, we see almost the same reaction from the Bank of England, the ECB, and even domestic central banks as well, just simply because there is that transmission mechanism from whatever happens with the US Fed to all the other economies, particularly frontier economies and emerging markets like Nigeria. So definitely what we're looking at is a scenario where we would see another tightening happening, simply because the US inflation actually did come in higher. Core inflation also increased marginally. And while we're still expecting further inflation numbers to come out, there is still that uptick in consumer spending that could nudge the US's inflation higher, and they will also definitely consider higher global prices and how that would push gasoline prices higher. So there is that chance of the US Fed tightening again, and once that happens, the US dollar would definitely strengthen, and that would then feed into importation costs for other countries. And as well, there is the impact of the investor sentiments, and how that would definitely feed into the Nigerian economy. Even though we're seeing treasury bill prices, treasury bill rates increase. I think the 364-day treasury bill rate is going as high as 13% now. Yeah, it's going as high as 13%. Even 90 days is going for about 6% now, and 182 days is going for about 7%. But by the time you look at what inflation numbers are saying, it's still a negative rate of return for investors. And if the US Fed increases interest rates, we will definitely see investors pricing all of this risk pricing this risk and probably move to a more stable economy like the US. However, the stock exchange has been doing pretty well, and we might see an influx of FPI inflows to the stock exchange rather than influx of
so much to unpack there.
Exactly.
Looking out for next meeting next Thursday. Let's see what oil prices will be at then. Thank you so much. It was great having you as always. Jumobi Oluwole, Senior Analyst, Financial Derivatives Company. Thank you.
Thank you.